Equity markets climbed high over the month amid better than anticipated earnings, particularly from the mega cap tech sector. We also saw positive performance from fixed income securities despite the high level of inflation. We believe that liquidity remains at the epicenter of what will determine asset market directionality going forward, particularly for risk assets. We have seen Federal Reserve facilities being utilized to prop up the banking sector, which has artificially provided liquidity to the market, which we believe has provided support inadvertently as well to asset prices. However, going forward, we believe that this will need to be reversed, as the Federal Reserve will need to tighten financial conditions to quell the inflation trajectory to keep it at more sustainable levels going forward, especially because core inflation remains at untenably high levels. However, we are cautious in terms of the liquidity dynamic flow going forward, particularly with the use of the Treasury General Account. So, over the last couple of months, we've seen the Treasury General Account being utilized as a source of funds, which has added liquidity to the market. So this is where the sale of US debt and US tax receipts go on a month-to-month basis. Going forward, we would not be surprised to see this account being drawn down further, especially given the debate that is happening around the debt ceiling at this current juncture. However, ultimately, we do believe cumulatively financial conditions will need to be tightened through quantitative tightening by the Federal Reserve, as well as a replenishment of the Treasury General Account from the US fiscus. China data remains incredibly resilient, as evidenced through the upside surprises that we've seen through GDP, retail sales, and the PMI data of late. Moreover, we see inflation at just 0.7% year-on-year in China, which will allow significant scope for further monetary policy accommodation going forward. However, more recently, we have seen escalated tensions between China and Taiwan at this current juncture. However, going forward, it is certainly not our base case that an invasion will take place, but it remains a tail risk in terms of our positioning. Other noteworthy events that occurred during the course of the month include OPEC supply cuts, which provided short-term support to the oil price before it subsequently retraced toward the end of the month. We also saw the UK CPI print surprise to the upside, coming in at 10.1% year-on-year, which really reiterates the cost of living crisis that we are seeing in the Western world, with core inflation also remaining at untenably high levels. We also saw the US first quarter GDP print come in at 1.1% annualized rate compared to Bloomberg consensus expectations of 1.9%. This is very much in line with our theme of a global growth slowdown that we're likely to see as the year progresses, largely due to the fact that the lag effect of monetary policy will begin to filter more and more into consumer behavioral decisions, particularly in discretionary-related expenditure, which we anticipate consumers will need to cut back on that type of expenditure going forward. Also, other noteworthy events that occurred during the course of the month were the Bank of Japan removed their policy guidance on their policy path of rates going forward, and they're going to take the next year and a half to conduct a monetary policy review of how they approach quelling or stimulating the inflation trajectory. It is worth reiterating that volatility remains the status quo in global markets. We remain particularly cognizant of a sudden reversal in terms of liquidity dynamics, largely due to the fact that the federal funds rate will likely be repriced in the futures market going forward to not have cuts priced into the market, but rather remain flattish toward the end of the year. Also remain cognizant of the Fed having quantitative tightening that is still ongoing, as well as other potential dynamics that might lead to a withdrawal of liquidity, such as a replenishment of the Treasury General Account.